Gentlemen, yeah, it's always a pleasure to be here with you because you are in such interesting markets, and therefore it's quite challenging to speak to you. You have always good questions. The title of my presentation today is Economic Consequences of Ambiguity. And this is something Mr. Šefčík mentioned. A lot of people are mentioning uncertainty. And here I use a different word for basically the same kind of phenomenon. Why I do this? Exactly, I think uncertainty is a better word, but I hope you will see later why I use this little bit unusual word for this ambiguity. Well, okay, the economic outlook for 2019, 20, and beyond. I mean, this is quite an interesting time to talk about this one, because we're in a situation where certainly the challenges are increasing, the risks, uncertainties, ambiguities, whatever you name it, are increasing. And we as economists, we always like to look at purchasing managers indices, obviously, because purchasing managers at the beginning of a production chain are always the ones who give us earliest signals about the future development of economic cycles. And we are at the moment in a very interesting situation because, as Mr. Šefčík was mentioning, especially the manufacturing sector is in a downturn. And here I've put in global purchasing managers indices for manufacturing in brown and for services in yellow. And you're seeing that obviously, especially manufacturing is severely hit by a slowdown. We are not already seeing this so dramatically in real economic numbers about GDP. Or industrial production, but these leading indicators give us a clear picture that something is building up here, especially in the manufacturing sector. And obviously for an economist, this is quite challenging at the moment to explain what's going on. With manufacturing PMI below 50 levels, this is certainly a situation where we are seeing increasing risk of recession. We have to deal with the problem, why don't we see it in services, but only see it in manufacturing, but certainly the alarm bells are ringing. Manufacturing PMI below 50, this is usually the best indicator for increased recession fears. But the point is, the usual reasons for recession are not on the table. Usually recessions come out of two developments, either monetary policy. Often monetary policy has to become restrictive to contain inflation pressures. And by becoming restrictive, it's often sending a single economy or the world economy, if this is coordinated across the globe, into a recession scenario. And the other point is financial crisis, like we saw in 2008. Everybody, or most of you will remember that one, that certainly a financial crisis is also a usual trigger for a global recession. We don't have to talk about this one. It's on everybody's mind who was in the market at that point in time. But both of these factors are not on the table at the moment. I mean, if anything, monetary policy is extremely loose, and we don't see any signals of a global financial market crisis. And therefore, our economists are struggling to explain what we are seeing here, why we are in a situation where recession fears are increasing. And here we come, obviously, because manufacturing is the one that's most affected, to the question of trade war. And the point with trade war is, now everybody will tell me, well, you see new talks between the US and the Chinese side, isn't this topic of trade war already abating? Are we in a situation where this has been a risk, but this risk is decreasing now, and we are coming off with everything being okay and fine, with a new trade deal between the US and the Chinese side, and then everything is okay. Sentiment in manufacturing will improve again, and we are getting out without any recession. That's a good way to tell the story. There's a little bit more skeptical way, and I fear the more realistic way is that I'm skeptical about the chances of this, especially the US-Chinese trade conflict, to be resolved in a meaningful way. Because it's not only about trade. I've brought with me a something that Mr. Trump said in May this year. He repeated it several times, and therefore Mr. Trump says a lot of things, but this is something he's continuously reiterating, and therefore something which seems to be at the core of his policy, which basically tells us it's not about trade only. It's not about the trade balance between the US and China that this conflict is about. It's not only about intellectual property questions in the relationships between the US and China. I fear that the target of this US administration at the moment is to contain Chinese economic development. And this is certainly something which cannot be resolved easily. The Chinese side can give in on demands regarding agricultural imports. They can give in on demands regarding intellectual property, but they certainly cannot give in if the US demands from them basically to be contained in their economic development. And therefore, I fear, even if we see something coming out of the US-Chinese trade negotiations that will happen in October, even something seemingly constructive will come out of it, this trade conflict between the US and China in particular will be something which is permanent, because it's not only a trade conflict, it's a much deeper economic conflict between these two nations, at least as long as this administration will be in place, and we will see if this will go on beyond 2020, but I think there's at least a chance that this administration will remain in place. And therefore, this is something where this trade conflict will go on and on, either in the form of trade conflict or in the form of some other economic conflict between the US and China. Because this demand, or this target or aim of the US administration to contain Chinese growth will certainly be something which cannot be solved, because there's no compromise on it. Chinese authorities cannot give in to such a kind of demand. And this brings me to perhaps one explanation, or at least one factor of the global manufacturing slowdown, which might explain what's happening despite the lack of the usual factors which are triggering recessions. And this is what economics call ambiguity, and therefore this is the reason why I use this word. I want to tell you a little bit about economic theory on this field. Sorry about that one, and I hope it's not too boring. This guy is Dennis Ellsberg, and perhaps some of you have heard his name. Dennis Ellsberg basically is famous for having published the Pentagon Papers in the 1970s. He was also he was working at the Rand Corporation, a US think tank at that point in time, and he was working in the field of game theory. And for those who are working in that field, he's not known for his publication of the Pentagon Papers, but for something else, which is the Ellsberg paradox. And I want to tell you this little economic theory to tell you how I think about the reasons for what's going on at the moment. Mr. Ellsberg designed the following experiment. Think of two boxes with red and black balls in them. In one box, there are 50 red balls and 50 black balls. And in the other box, there are also red and black balls, but you don't know how many of them. Now think of a situation where you are offered the chance to earn, let's say, 100 euros if you pick a red ball. And you can choose which of the boxes you take your ball from. And this is an experiment. I mean, we could do it here, but it has been repeated several times in experimental setups with a lot of people. And usually people choose the box where they know the share of red and black balls in them. Therefore, they choose the 50-50 box, and not the one where they are uncertain about the number of red and black balls. Why? And certainly, if you offer people something like this, and you tell them you earn 100 euros if you pick a red ball, they choose the left box. If you offer them the same game and say you get $100 if you pick the black ball, then they also choose the left box. It's not about red or black per se. It's about the fact that on the one side, we are knowing the risk. This is a word economists use for this. we can calculate the chances of picking a red ball. And on the other side, if you choose from the right box, you don't know the chances. This is what economics call ambiguity, and this is something people hate. People hate risk, obviously. You would like to know what your steel, what the world steel demand is up to the last ton. You don't know, and therefore certainly you hate risk. But what people usually even hate more is what economics call ambiguity. A situation where you don't know what the chances for different outcomes are, where you even are not certain about the playing rules of what's going on at the moment. And I think the situation in the US-Chinese trade conflict, but also in other areas we are picking up in due course, we are seeing this kind of ambiguity. And therefore, I think the economic consequences of what's going on are more dramatic than what we usually think. Look, when the US and Chinese entered this trade conflict, our economists and my team were quick in setting up models on what will be the economic impact. And the economic impact of tariffs is large, yeah, and tariffs are bad, but it's not so dramatic to send the world economy into a recession by itself. I think the reason why we are seeing such a big impact on manufacturing sentiment and probably on global growth is because this is more the kind of ambiguity situation that we are seeing in the Ellsberg paradox, and therefore the effect of it is larger than in a situation where we could say, well, the probability for significant US tariffs to remain in place is X%. In that situation, it would still be bad if this X would be a large number, but it's a situation where we can all deal with. At the moment, everything seems to be possible. Look, I mean, we are in a situation where raising tariffs on a global level is something we have not seen basically since the 1950s. Since the introduction of the GATT system, we always saw tariffs going down basically on a global level. This was not true for certain products, this was not true for all pairs of countries, this was not true for all points in time, but in general we saw a downward trend. If you had asked me 10 years before if I would see a realistic chance of tariffs going up on a global level, I would have said, no, you can ignore this risk. Things we thought could be ignored are high on the agenda now. And this is the kind of situation which I think is more, in economic terms, best described as ambiguity. Difference in risk, with which we all can deal, and we can put it in our risk management models, etc., and therefore we can handle it very easily. Therefore, I'd like you to think of this ambiguity problem when we talk about certain situations on the next slides, as basically the main problem of the situation we are facing at the moment. Okay, so we have to talk about different economies because different economic situation is different in different countries. And first of all, we start with the US. Here, obviously, we have the same picture. PMI in non-manufacturing, basically services in yellow, holding up pretty well. PMI in manufacturing diving down in the last numbers especially, and now also below the 50 level, therefore also in the US manufacturing sector, recession-like signal. First of all, this does not mean that we will have recession with 100% probability. I've brought here a longer slide going back to the late 90s to show you, yes, normally ahead of a recession or inside a recession, we have this dip in PMIs, but we also had dips in some points in time here in late 2002, early 2003, here in 2015, for example, where we had PMIs below the 50 level, and this was not followed by a recession. Therefore, we are not certain that this will end in a recession-like scenario. There is risk that this will end in recession, but especially for the US, I would argue this probability is not so high. We see the late effect of the US tax reform going on. We probably might see another tax reform going on. This will beef up economic growth, at least for a couple of years. Long-term consequences are a completely different story, but for the next couple of years, this could beef up economic growth. And therefore, I would still say that the US probably might avoid a recession. But obviously, for especially an industry like Yuan, it's this uncertainty or ambiguity which is slowing down production in the early phases of production cycles. So we are in a situation which is quite difficult in the US. And Mr. Šefčík mentioned, yeah, monetary policy might help, and monetary policy in the US is helping. We are seeing that the Federal Reserve target range for their interest rates has risen constantly until late 2018, and now there was a first step down. This target range is going down. Forget the effective rate. This is a special factor which is completely irrelevant for economic growth. And we saw a second rate cut. You only see the first day here because I did it just one day after the Fed's meeting. So the Fed is on a cutting cycle, but market expectations about this one have become a little more cautious. The orange line is telling you where the market expects the Fed fund rate to be by the end of this year, and the yellow line by the end of next year. This has come up a little bit, and this has certainly to do with the situation of seemingly easing trade conflicts between the US and China when it was announced that they will talk again in October. But this also has to do with the limits of monetary policy. Look, what we are seeing here, and this is also one of those ambiguities that are making the situation for everybody in the world economy so difficult at the moment. We are seeing that monetary policy is coming near to the end of its means. And I'll skip the next slide, I go to this one. The FOMC members, those in the US Federal Reserve that are setting the interest rates, are also providing us with projections about their own monetary policies. And I've copied this chart that they are publishing every time after the meeting into it. The interesting thing is this one for end 2019. The FOMC, the members of the FOMC are split in three camps. One is expecting one further cut over the course of this year. One is expecting interest rates to remain constant until the end of this year. And nearly a third of those FOMC members are expecting rates to be hiked again after they have been lowered last week. I mean, these guys who are thinking rates will go up again until the end of this year regard even the last rate cut as a policy error. It would not make sense for a central bank to cut rates in September and to hike them again before December. This would be some up and down monetary policy which is of no use. Therefore, a third of those policy makers in the US are already thinking with the second rate cut that the Fed conducted this year, the Fed has already gone too far. And why do they think it? They think it has gone too far because they think easing monetary policy through rate cuts and through other measures in other central banks is something which does not help anymore. This is something which, this is a point of view with which they agree with the market. Now I'm going back to this slide. These are inflation expectations, five-year inflation expectations on financial markets. You can bet on everything. Here's the bet of the market on the average inflation rate between 5 years' time and 10 years' time. Therefore, between 2024 and 2029 at the moment. And we are using this one as a measure because nobody knows what the cyclical situation in the US will be in 5 years' time or in 10 years' time. And therefore, this is not a bet about inflation given any specific cyclical situation. This is the bet of the market on inflation in the long run, on the average above all cyclical situations. And this has deteriorated sharply in 2018 and also at least until mid-2019. And it's only picked up a little bit when we saw this good news about the US-Chinese trade conflict. But this has deteriorated at a time when the expectation of the US about US monetary policy was falling. The market was expecting the Fed to become easier and easier and easier in their monetary policy, but the market was telling us with this one, it thought this all is in vain. Inflation will not reach the Fed's target. For the Fed's target to be reached, this measure must be round about at 2.4%. And the market was telling us, even in the long run, even between 2024 and 2029, the Fed will be unable to reach its target, despite the fact that everybody knew and everybody was expecting them to hike now and hike more and more and more. So the market does not believe in monetary policy anymore. And this is something which is very difficult for central banks. Because without inflation expectations, central banks will not be able to generate inflation. If you guys think that your competitors will not hike prices, if your inflation expectations are low, it's much more difficult for you to hike prices. And this is not only in the steel industry, it's obviously in every kind of economic activity. Therefore, we are in a situation where without inflation expectations, central banks will fail. And the attempt of the Fed to increase the inflation rate by cutting interest rates has failed basically before they already started. Inflation rates have come down. The market is telling us they don't believe in central banks' expansionary monetary policy to have any effect anymore. And this is certainly something which adds to this kind of ambiguity, because now we are, for the first time, at least in the last 40 years, in a situation where markets don't believe in the central bank's ability to steer economic variables to a significant degree anymore. And this is certainly something which is this new kind of ambiguity. We have not been in this situation, and therefore we don't know what an economic downswing will look like if we don't have central banks which will be able to counter them with monetary policy measures. And this by itself might be one of the reasons why we are seeing this deterioration in sentiment of purchasing managers. Because central banks were always basically creating a kind of insurance. Whatever bad happens in this world, whatever bad happens to the economy, in case we would get into a difficulty, central banks would cut interest rates, loosen monetary policy, and this would then help and revive the economy. Now, as markets have distrust in this ability of the central banks, we have one insurance less, and this is by itself creating sentiment, as we've seen before, to a good part. And obviously we also have a further layer of uncertainty about monetary policy, which is the US president's influence or tweets about, and where he's blaming the Federal Reserve for not taking enough action. This brings the Fed into a very difficult situation, because in the long run it's extremely important for them to be regarded as politically independent. A central bank which is politically dependent will in the end either be unable to control inflation or have to pay a much higher price to regain confidence in their independence before they can steer inflation successfully. And therefore, the Fed, is in a situation where they probably would like to cut interest rates, but cannot do it as they would do without these tweets, because they have to take into account that every rate cut they take might be regarded as giving into the political influence, and therefore they are in a much more difficult situation. And this is also basically then one part of the story why the market lacks confidence in the Fed's ability to control inflation. Now let's come to the second largest economy, China. Here we see the same situation. I only brought you here manufacturing PMIs. They are showing a downward trend. There's some differences between the private sector, which is more the gray line, and the public state sector, which is more the yellow line. Both have their ups and downs, but we are seeing the same again. Not in a dramatic fashion, actually, but certainly dramatic enough to raise, obviously, concerns about the economic future of China. And this by itself is quite a complicated story, I think. Because what we are seeing here is basically two effects. One might be the cyclical one that we are seeing on this chart, with a slowdown in PMIs by trend, but with some ups and downs on political measures, on trade measures, etc. We see these ups and downs. But we also have a overlaying problem there, which is Chinese growth slowdown, which is going on for quite a while. I mean, in the early 2000s, we had these double-digit growth numbers in China, and this was over basically at latest by 2008, I would argue by 2007 already, and then we are seeing growth slow down. And this is something which should not surprise us by itself, because in the long run, the Chinese economy would not have been able to sustain double-digit growth rates. And in the very long run, the Chinese economy will also not be able to sustain growth rates of 6%. I mean, if they would have 6% growth rates for 100 years, and industrial economies would have growth rates around 1 or 2% for 100 years, China would be so much wealthier than the rest of the world. This is a situation which seems unplausible from an economics point of view, because in the very long run, basically all economies in the end tend to grow by roughly the same rate. Therefore, what we are seeing there, my interpretation, our interpretation at Commerzbank of what we are seeing here, is that China had a growth boost in the early 2000s by its growing trade with the rest of the world, WTO membership, etc. And this is running out now. And now we are seeing a long-term situation where Chinese growth rate will come to levels in the long run where they are in the rest of the world, like with every country in the long run. If at current speeds, this would bring China roughly to a per capita GDP level of 50% of the industrialized economies, therefore roughly to the situation comparable to Russia. So this is a situation which is normal from an economic point of view. But it's also difficult for Chinese authorities, obviously, because this obviously brings a lot of economic, political, social problems with it. On the economic side, obviously, the question, is there significant overcapacity in many sectors, which has been built up in these boom years of double-digit growth rates and which still persists, especially as the high savings rate induced a lot of investment inside China, which is creating this overinvestment bubble in many industries. But the other point is obviously then now the cyclical situation. The cyclical situation is something which is, as you saw with the PMIs before, something which is raising concerns, but which is hard to discern from this longer-term economic slowdown. And the point is, how do Chinese authorities react in this situation, where we have some normal tendency of lower growth rates, but at the same time, cyclical risks. And my interpretation of what the Chinese authorities did so far in this downswing is that they are accepting this long-term economic downswing. Why do they accept it? Because last time they tried to run policies which would stop this one was in 2015, and in 2015, this boom in growth in loan creation created bubbles among the financial system, created bubbles in a lot of industries, created bubbles in the housing market, which are systemically dangerous. Therefore, my interpretation of what the Chinese authorities are doing at the moment, they are accepting this long-term economic slowdown. They're accepting that in the long run, they will even not have persistingly growth rates above 6%. They will at some point come below 6%, at some point they will come even below 5%, perhaps even lower. This is something the Chinese authorities are accepting because they have seen from the experience in the past, in 2015, where we had these high growth rates of loans from the financial institutions, that this is something which is only creating systemic problems in the banking system, and a lot of companies which are over-indebted, etc. They don't want to repeat the mistakes they made at that point in time. And therefore, they are willing to accept that we see this long-term slowdown of the Chinese economy. And therefore, I don't think that we'll come back to 6.8, 6.5 or something like that in growth rates regarding China. These times are over. The only thing the Chinese authorities are trying to prevent with their political measures, by keeping up at least the loans from financial institutions high, while depressing aggregate financing from non-bank financial institutions, the shadow banking system. They want to prevent a crisis-like situation in the Chinese economy. This is something where we are seeing clear signals, not only on that side in terms of monetary policy, lowering reserve requirement ratios, etc. They are steering the economy, but not with the aim to come back to higher growth rates than we are currently seeing, but only with the aim of managing this long-term slowdown in Chinese growth. This is all we can expect from the Chinese economy. Not back to the good old days of 10%, obviously not, but even not to the good old days of 7%, I think. They are managing this slowdown in a way that is not falling to crisis-like levels. And this is all we have to expect from China, I think. On Chinese renminbi, I'm coming from the fixed side, therefore let me tell you a word about Chinese renminbi. Forget this chart. The only thing I want to say there about this one is the Chinese authorities are obviously using dollar-renminbi exchange rate as a tool in their trade conflict. We are seeing in our analysis that I brought with me here that the jump of dollar-renminbi exchange rate above the 7 level and then to the 7.15 region was something which was managed by the Chinese authorities. Sure, in the end, it was the market which has decided to trade dollar-renminbi above 7, but only because Chinese authorities opened the door for such a move, as can be seen in the counter-cyclical factor in the PBOC's renminbi fixing, something very technical we don't have to see. Therefore, basically, sure, renminbi exchange rates are a tool of overall economic and trade policy in China. But at the same time, what we are also seeing is the Chinese authorities want to prevent dollar-renminbi from going up on a trend-like basis. After these steps of dollar-renminbi above 7, of dollar-renminbi above 7.15, we saw the Chinese authorities, the PBOC, was containing this renminbi weakness. They don't want a trend of ever weakening renminbi because this is something which is also quite dangerous. Look, in 2015, in the last economic slowdown episode, we saw hefty capital flight out of China. I mean, the PBOC, the Chinese central bank, lost a quarter of their reserves, quite a lot in a very short period of time. This was a very dangerous situation, actually. They don't want this to be repeated. But if you would see a trend of weakening renminbi, this would only spur capital flight again. And therefore, I don't think this is a tool which they will use in that way. Not a trend of weakening renminbi, but giving signals to the US side at every time that it's permitted regarding the negotiations between both sides on trade topics. This is, I think, the strategy we have to expect. And if we would see a solution, I would argue not a permanent solution, but an intermediate solution in the trade talks, I can think of at least a stabilization of dollar-renminbi exchange rates, if not a little bit stronger renminbi at that point in time. But obviously not too strong, because in this economic slowdown, Chinese authorities would be unwise if they would manage renminbi to get too strong, actually. And therefore, I don't expect renminbi to recover fully, even if you will see in October a compromise between the US and China on trade topics. Now, we have to come to Europe and to the Eurozone, and again, the same situation. Again, the situation that services are holding quite well, and manufacturing is quite deep in recession territory, with these indices below the zero line. Therefore, again, the same situation here. And obviously, the dangerous part here, as in the US, as in China, is will services follow? We'll see a recession, a much clearer recession signal if services will follow. This is not happening at the moment, but as soon as you see that one, and therefore this is a point you have to look at, as soon as services will follow, we have a much stronger recession signal. When will services follow? Only if this slowdown in the manufacturing sector has meaningful effects on unemployment, on private income, At that point in time, we will see certainly effects also on the service sector, and then we would be in recession territory. Therefore, this would be the dynamic through which the current situation could evolve into recession-like scenarios for the overall economies and not only for the manufacturing sector. And here again we have to talk about monetary policy, because this is something which is even in more difficulties in some respect than the US monetary policy. Here's a key interest rate by the ECB, the ECB's deposit rate in gray. We don't have market expectations for that precisely, but we have market expectations for an interest rate called EONIA, forget about the details, which is following this one very closely. And therefore this was the market expectation before the last ECB meeting. It took the data on 9th of September, a couple of days before the ECB meeting. And the market was expecting the ECB to be extremely aggressive. ECB interest rate already was at minus 0.40. The market was basically expecting the ECB to cut to levels of minus 0.80 by the end of 2020. Minus 0.80 is a very ambitious level. I mean, when I studied economics, my teachers told me interest rates cannot go into negative territory. Obviously, this is not true. But I think there are some lower bounds for interest rates. There are some lower bounds because if the ECB really would have cut to minus 0.80, you could have two possibilities. Either, I mean, this are interest rates that the ECB is charging, because they are negative, on deposits that the banks in the Eurozone, for deposits the banks are storing at the ECB. So either the banks would have not transferred these extremely negative interest rates to their customers, then we would see a reduction of the profitability of the Eurozone banking system. Now, as I'm employed by a bank, this is a story which is a little bit difficult to tell from my side, and obviously it's not the main task of the ECB to maximize the profitability of the Eurozone's banking system, but if they reduce the profitability so much, like the market had expected here in early September, then they would have run into a completely different situation. Because at the moment we are seeing that the banks are holding large amounts of excess reserves in their accounts at the ECB. This is a situation we never saw before 2008. Before 2008, every bank was trying to get their excess liquidity at the ECB as close to zero as possible. Because at that point in time, liquidity was a restricting factor of a bank. If you had more liquidity, you would increase your lending business, and therefore this would reduce your excess liquidity, and therefore you came up in a situation where your excess liquidity was zero. Excess liquidity is money which does not earn any profit for the banks. And therefore, they tried to reduce it to zero because liquidity was a restricting factor. After 2008, we are seeing large amounts of excess liquidity in the European banking system. And this shows that liquidity is no longer the restricting factor for banks' activities. Why are the banks not creating more loan business in the economy? Because they have some other restricting factor, obviously. And this other restricting factor is quite obviously equity capital by banks. Due to banking regulation that was set up in the last years, banks need quite high amount of equity to create loans in the economy. And therefore, this is something which is now the restricting factor. But if the ECB would have cut interest rates to minus 0.80 and would have reduced the profitability of the European banking system, we would have been even in a more dire situation regarding the equity capital of banks. And this would have reduced the bank's ability to create credit and loans in the economy even more. So this would not have been an expansionary monetary policy, but would have had restrictive effects. The ECB saw this situation, and therefore it told the market basically after its last rate cut, they cut rates again, but they told them you are wrong, and now we are seeing that yes, one further rate cut is priced in by the market, but not these extremely negative interest rates. But this also tells us that the ECB is near the end of its monetary policy. They cannot do much more in terms of cutting rates. They're at the end there. Okay, they have revived their Q&E program. They are buying more assets and therefore creating liquidity on that side. But as I said before, liquidity obviously is not the restricting factor for creating loans. And therefore, this is a situation where the economic effect will be very limited. We are with the ECB, we have with the ECB a central bank which is very, very close to the ends of its monetary policy means. They cannot help anymore if the Eurozone economies goes into recession. And this is certainly a situation which makes the situation, which is quite frightening. I told you we are not seeing at the moment clear signals for a recession yet, but the fear of it, despite relatively low probability, is that we will be in a completely new situation. And Mr. Shevchik mentioned it also. I mean, in the end, at that point in time, fiscal policy could help. But if we would go into quick recession, this is something which usually comes too late. You see quite a large time lag between going into recession and fiscal policy being effective. You need some planning period before fiscal projects can create actual demand. And therefore, usually the quick instrument that you need to retain recession dynamics is the monetary policy. And that's the one that is missing in the Eurozone because we are near the end of the means that the ECB has. And therefore, this is creating this new ambiguity. We don't know what would happen if Eurozone would go into recession and the ECB would not have any strong instruments because they cannot cut interest rates. They can cut interest rates for a short period of time, but not very long. And therefore, this is a problem where the market would react on such a rate cuts completely different than everything we experienced in the last decades regarding the effect of monetary policy. That's the difficult thing about Eurozone. And in the end, let me talk about this guy, because obviously we have to talk about Brexit risk. And here again, we have this problem of ambiguity. We have this problem that things can happen where normal risk calculation does not tell us much. You know, we and a lot of other analysts usually make these charts where we are plotting which possibilities there are, a possibility tree, and then we write some probability numbers to each branch of this tree, and then we come up with a probability of no deal Brexit, no Brexit, or whatever the possible outcomes might be. We do it because our clients demand it from us, but frankly, this is nonsense. Because, frankly, what does probability tell us in this case? What's the probability of the no-deal Brexit? I can tell you any number. Let's say I say 20%. So in the end, I'm always right, because either it happens and I said, well, this is a 20% event, or it doesn't happen and I tell you, well, this was the 80% event. Probability in the end is something which is useful if you have multiple occurrences of an event, and then it's the frequency by which one or the other event comes out. We only will have one Brexit, and therefore, if I attach a 20 or 80% probability to no deal, this does not help you in your business. This is a unique event, and therefore, the probability of no deal still is at least so high that it cannot be ignored. And therefore, it does not matter if it's 20, 30, or 40%. It's a possibility which cannot be ignored, and it still cannot be ignored. Even the risk of a no-deal Brexit on 31st of October, because the British Prime Minister has made clear that he seems to be unwilling to obey the law, which tells him he would have to ask for an extension if he doesn't have a deal on the 19th of October. He so far has said he would not ask for an extension, and therefore we are in a situation where we even don't know if a British Prime Minister obeys the British law. This is certainly something which I would call in these economic terms ambiguity, a completely new situation which we also did not even think of only 10 years ago. This does not have to happen. I mean, we have this withdrawal bill which tells him to ask for an extension, and perhaps he will do it. But we have also to deal with the possibility that it does not do it, or even if it does, and we see an extension beyond 31st of October of the EU membership of Great Britain, then we again will be in a situation where we don't know what the end outcome will be. And the end outcome in case of a no deal, I think, might be quite dramatic. Not dramatic in the way that most people think, but dramatic in another way. What I show you here is the current account balance of the UK. Basically, the number of goods and services that they are importing versus the number of goods and services they are exporting, the difference between those, and it's deeply in negative territory. The UK economy is importing much more than it's exporting. And someone has to finance this party. And if in case of a no deal, the rest of the world would be less willing to finance this one, this might end up in a situation where we see a very significant sterling depreciation and a very significant contraction of the UK economy. Because at least this yellow part, balance of goods and services, then could contract quite sharply, but it is still minus 5% of, minus 5% of British gross domestic product, and by this the British would have to consume less and to invest less. Then we might see a contraction of the UK economy in a very relatively short period of time by this amount. And this is a lot. And this can happen quite quickly. We saw it in the Asian crisis. We saw it even in UK 2 times in the recent past. In the early 90s, when the UK dropped out of the European monetary system, and in the mid-70s, when they had their current account crisis. In both cases, pound sterling lost roughly 30%, a little bit more. Now, pound sterling has lost something after the UK referendum, but not so much. And therefore, in that case, we might still see a lot of nasty things happening with pound sterling and happening with the UK economy. And here again, the effect of ambiguity is quite visible. Business gross fixed capital formation, basically investment of the UK economy. We saw a very heavy drop even after the referendum, despite nothing had happened, despite the fact that in case of a deal Brexit, if they conclude with a deal close to the one that's on the table currently, the economic consequences would not be very large. But only because we don't know what will happen, we saw this heavy drop in average investment, nearly to zero, and in the recent past, even lower. And here again, the monetary policy is in a situation where it can help a little bit, but not much. Because if we see a dramatic drop in pound sterling, Bank of England will find it extremely difficult to cut interest rates, because this would make this drop in sterling even more severe. Normally, central banks raise interest rates at that point in time, like we, for example, saw in the European monetary systems crisis in the early 90s, when some central banks raised their interest rates to 500% to contain a drop in their currency. This is a situation the Bank of England might end in. And therefore even here, monetary policy potentially has its limits if we come to a nasty situation. And therefore we are in a situation where basically we see the world economy facing new kinds of problems. Uncertainty of a different kind. Uncertainty of what I call, or what economists call, ambiguity, a situation where we are facing new challenges. We don't know how economies react when they're going into recession and central banks cannot do anything. We don't know how the US-Chinese trade conflict will end up, because we have to assume that this is not only about trade. We don't know how Mr. Johnson will decide if you get a no-deal Brexit on 31st of October or not. And we cannot use probabilities to tweak our risk models here. This is a kind of challenge which, from my point of view, is the main reason why we are seeing depressed economic activities around the globe. And I fear this is something which will persist for quite a while. Therefore, I'm still quite optimistic and don't expect world economy to go into full-blown recession. But I fear that as long as these uncertainties prevail, we will not see a recovery. And this might be quite a long time period. So not such an optimistic outlook. Sorry for that one, but that's my outlook for the world economy. Thank you for your attention. Do you have questions? Over there.
Yes, I have a question. Early on, you showed the graphs, and you suggested that markets no longer have confidence in the central bank's policies for expansion, et cetera. Was that basically a lead-in to the other graphs we saw and the current situation with the ECB? Or are you suggesting that overall, the central bank's tool of increasing interest rates to slow down an overheating economy or lowering them to increase is no longer valid?
Yeah, I mean, frankly, I mean, the one who answers you this question will get the Nobel Prize in economics. Therefore, don't expect me to give you the final answer about that one. But sure, we are in a situation where it's extremely strange from all the economic theory that we know that this loose monetary policy was not able to bring up inflation rates. Therefore, somehow, for some reason, we don't understand completely. The whole economic profession does not understand completely why this is not working anymore. On the upside, if we would see rising inflation rates, we still have much confidence that central banks could dampen rising inflation by raising interest rates and conducting a restrictive monetary policy. Therefore, on that side, we are not so much concerned. The concerns of economics is that for some reason, we don't know, frankly, we are in a situation where we cannot get out of this zero inflation, low growth situation with the usual monetary policies. And central banks have done everything to avoid this situation. They have done things nobody, and even the central bankers, could think of 20 years ago. But the point is, we have one example, and this is Japan, where a central bank already has done everything possible, perhaps without helicopter money, which is perhaps the last measure that they might think of, that they have done everything without getting out of the situation. And therefore, and this is not because the Bank of Japan was not brave enough, etc. I mean, the Fed tried the same one, and we are still in a situation where the market does not expect them to be successful. And the ECB also, it's at its end of its means, but inflation expectations in the Eurozone are even lower. So we are in a situation where central banks, for some reason they don't understand, are not successful. If they would understand it, certainly they would do something different. But they don't have any idea anymore. And the market has lost confidence in them to bring up inflation, to bring up growth. And therefore, because the market has lost confidence in them, they've already failed.
I have a question. Mm-hmm. Thank you very much, very interesting. If you had been giving this presentation 10, 12 years ago, you probably would have had a slide about household savings rates. That China and Japan was saving too much, the United States was saving too little, and Europe was just about right. So why is savings rates never on a conference in the last 2 or 3 years? Is it irrelevant for this economy?
No, it's not irrelevant, but we don't understand it, frankly. This is the core of the problem that we as economists don't understand. The normal reaction of savings to lower interest rates would be, well, it's not worth to save, I'm consuming. So obviously, the models under which all central banks that are conducting expansionary monetary policy at the moment are working is we are lowering interest rates. This brings up investment, this lowers savings, and therefore we are in a situation where we'll get higher inflation, higher growth, etc. This is not working, and the fact is central banks don't understand why this is not working. And this is the core of the conflict, of the problem that central banks have. We don't know why households are not reacting on lower interest rates with lower saving, why they are still saving so much. Especially in China, this is a problem which is long-term. I mean, China is an economy with a saving rate of 40%. It's roughly double the one of industrial countries. And this obviously is creating problems of overinvestment, of overcapacity in the Chinese economy, which was something which could be solved when the Chinese economy was opening up to the world economy in the early 2000s, but now a problem as this process is not creating additional dynamics. So we don't know. I mean, I have my own theory. I think it's more about demographics. Because we are in a situation where in most industrial economies, baby boomers are in a situation where they are close to their retirement age, but still sufficiently far away from it that on the one hand they have to save much. On the other hand, this saving does not have to go into investment and increased capital intensity of the economies, because the robots that would be installed today that serve me when I'm retired would be too old once I retire in 10 years' time. So far, this might be something which explains the situation, and this might be the explanation why Japan is in the same situation already for 20 years, because they had their first baby boom 20 years before the rest of the industrial economies. But as I said, this is something central banks cannot rely on at the moment, and therefore this is a reason why they are in a conflict now.
Yeah, if I may ask a question. Thank you for the talk. I'm basically currently reading a quite detailed book about debt cycles. Mm-hmm. And actually I want to ask you, how do you rate well, I don't want to say probabilities, but what is like your take on the risk for basically a debt crisis that we see that comes, for example, from private debt from China? Mm-hmm. And yeah, how do you mitigate it?
Yeah, I mean, sure, we are in a situation where, especially in China, due to this policy of the 2050 and afterwards, we are in a situation of high debt. I have this chart, where is it? Here, where we had 16%, nearly 16% growth of bank loans in 2015, and afterwards also quite high growth of bank loans. Certainly, we are in a situation where we are seeing over-indebtedness of some players in China, and also over-indebtedness of some players in other countries. But this is obviously the effect of the monetary policy in the Western world, in Europe and in the US. We had this extremely loose monetary policy, and the only way such loose monetary policy can work is by creating demand for more credit. And therefore, this is something which, on the one hand, is just what the central banks want. On the other hand, this is creating obviously long-term problems. In the end, nevertheless, this is something where, and the fact that we are seeing high credit growth in China, but also in Europe and in the US, is only telling you that at least part of the monetary policy is not totally dysfunctional. That part of it is coming through, because this is just the way monetary policy works. They cannot, the ECB or the Fed cannot buy goods. They create situations where the banks are increasing their lending activities. Therefore, this is just what they want. But sure, this creates another kind of problem in the long run. I'm in a camp that does not overemphasize this over-indebtedness problem, because the debt of one guy is the savings of another. Therefore, you could tell your problem of over-indebtedness, the same situation you can describe as over-saving. And I like to describe it as over-saving. There are risks which are specific to the debt side of the story, but the strange thing and the core of the problem, I think, is in the saving side. Why are people saving so much despite the fact that we have so low interest rates? Why are even companies saving so much despite the fact that we have low interest rates? Why are they not investing like hell? Look, we are having in Europe 10-year yields at negative levels. We have low inflation, but the market is expecting at least 1% inflation for the next 10 years on average. Therefore, we have negative, risk-free side, negative interest rates for 10 years investment projects. And even, look, the Austrian government has issued a 100-year bond, and it's yielding around 0.7%, therefore below the inflation expectations. This is something where economists cannot explain why all the industry is not investing like hell. In a situation where for 100 years you don't have to pay back more than the money that you invest, every investment project should be profitable. Ben Bernanke, the former Fed governor, told the story of why is not someone coming on and creating a big tunnel through the Rocky Mountains and and charge $1 or let's say 20 cents for everybody who's driving through the tunnel. Whatever this tunnel costs, this project is profitable with negative interest rates. So why is this not happening? Why isn't there a tunnel through the Rocky Mountains and even larger tunnels through the Alps? Why do we have the Alps? Why does not someone scrap the Alps away totally? Everything is profitable with negative interest rates. So why is this not happening? Why don't we see a massive investment boom? Central banks don't know. My explanation is a small analyst at a German bank is basically this demographic story. Because we have this baby boomer situation where everybody is expecting that, or a lot of people are expecting that they need more money in the future, while investment for that period is not possible yet.
What is the equivalent of our prime rate in Europe, the corporate borrowing rate in Europe?
Well, I mean, I could give you a number. The problem is that we have basically a segmented, still have a segmented banking market. Therefore, we have it, we have basically have to apply different rates for different countries, etc. But it is basically not above the inflation expectations of 1%, even in countries with arguably relatively distressed banking markets like Italy.
So let's say in Germany, is it 1% in Germany?
Yeah.
Prime rate is 1%?
Yeah, roughly.
And what's the bank's reserve requirement, like Commerzbank's reserve requirement?
The reserve requirement is very low, but the banks have much more reserves in the Euros, at the ECB as excess reserves, not because they want to, but because the ECB forced them to. Look, for every unit of quantitative easing, for every bond that the ECB purchases from the banks, they give them liquidity. And therefore, they enforce a huge amount of excess liquidity in the banking system. And the banks have this as excess reserves at minus 0.40 at the ECB.
And last thing I want to ask is, you just mentioned Austrians as a 100-year bond for 0.7%. Was there any demand for it? Did anybody buy it?
Yeah.
Sure.
Yeah. People buy 100-year bonds for 0.7%. Frankly, I don't understand why governments don't spend like hell in such a situation. Is there nothing a government can do with money which earns 0.7% nominal minus 0.3% real for 100 years? Isn't it worth to build new roads, to invest in schooling, whatever, at that point in time? But we don't see this government spending in the Eurozone. In some countries they can't. Perhaps you could argue in Italy. In some countries, for whatever reason, they don't want, like in Germany.
Next one, Mr. Ševčík.
Thank you for an excellent presentation. The word ambiguity is getting new dimension in my understanding after that. I have two questions, actually. First one is about investments in China. You said that the expectation of 6% growth rate of GDP, it will be quite reasonable. What will be the composition of this GDP? That's the first decomposition of GDP.
In terms of
share of investment.
Yeah.
And the second one is about U.S. trade tensions, U.S.-China trade tensions. In my country, we usually say that if two are fighting, the third one is winning. Can you name, do you have a view if there are countries which are gaining out of this situation?
Sure. I mean, to answer your second question, this is quite easy. This is certainly the rest of East Asia. I mean, we are seeing a hefty rise of exports from Vietnam to the US, for example. Vietnam is the best example there. But I would also say it's the rest of East Asia, but Vietnam is especially relevant there. Okay, at the same time, you see also a quite heavy rise of Chinese exports to Vietnam. Therefore, you must argue how much of value added from these new exports from Vietnam to the US is really happening in Vietnam or how much is imported from China, just to get a exported from Vietnam label instead of exported from China label on it. But nevertheless, even if you would argue that this new boost of exports from other East Asian countries is basically to a large part Chinese value added, you still have to admit that this is something like creating larger trade ties of the rest of East Asia towards the US in a direct basis. And therefore, even this will have long-term consequences. Therefore, I think the rest of East Asia is clearly the winner of this one. First question was Chinese decomposition. Yeah, I mean, we are seeing growing share of consumption in GDP in China. And this is something which is good and which is natural. But we are still, the levels are still ridiculously high in terms of investment. And therefore we are seeing, we certainly will see to some extent larger share of consumption. But investment, the investment part, as I said, roughly 40%, nearly 40% of GDP, is something which is slowing, from my point of view, perhaps at a lower pace than would be justified given that we are seeing a secular downward trend in Chinese growth rates. And therefore, this overcapacity problem in China persists, creating financial stress, financial risk, etc.
Thank you very much. I think we have got lots of questions. Thank you very much, Mr. Leuchtmann.
Thank you.